Good morning and welcome to this Bloomberg India Edition special conversation. Now, India Edition is a weekly newsletter that I write for Bloomberg. It offers an inside view of India's big businesses, billionaires, and of course, bonds. We've got it all covered for you in that newsletter. If you haven't subscribed yet, then please do just scan the QR code that you can see on your screen right now, and you'll be able to sign up fairly easily. If you'd like more than just a weekly dose of India news, then sign up to Bloomberg India's WhatsApp channel. We post the day's top 2 or 3 stories there. So no spamming, not a litany of stories. Again, you can sign up using that QR code on your screen. And one final request to our audience that's just joined us. We'd like our special shows like this one to be interactive. So please send me your questions for our expert guests. Whatever platform you're watching this on, post your questions there, and our teams will aggregate them and we'll try and put all of them to our guests. And we already have a few questions coming in, so thank you guys for that. Now let's get to the main event. It's a milestone day for India as its sovereign bonds debut on JPMorgan's biggest emerging market index. That's the GBI-EM Global Diversified Index. Now, this is just the first. Next year, other key indices will be adding India sovereign bonds as well. Just today's event is expected to draw between $20 billion to $40 billion in foreign fund flows. And while that's a small amount relative to the size of India's bond market, it could double the foreign ownership of government bonds. What impact will this index inclusion have on India's economy, rates, and currency? Joining me this morning to answer that are 2 expert guests and 2 top portfolio managers, Leonard Kwan of T. Rowe Price and Howe of Principal Asset Management. Thank you to both of them for their time. I'd like to start with Leonard Kwan first. He's also portfolio manager of the dynamic emerging markets bond strategy and co-manager of Asia Credit Bond Strategy as T. Rowe Price. Leonard, you told me yesterday when we were talking about this event that you thought it did more for the JPMorgan index than it did for India. Could you elaborate on that?
Yeah, let's start there. Thank you, Menaka. For a start, it's the India government bond opportunity set outyields the JPMorgan index. So that's something that we look for, higher yields. It has a lower volatility profile, both in the price of the government bonds and also on the currency front. And the outlook is fairly constructive in terms of the view on the Indian economy. And it helps to diversify the index. So from our point of view, it's decorrelated, it's a high yielder. There's a lot of positivity on that. So those are reasons why I think it's a good idea to add it to the JPMorgan index. And the other thing that you pointed out as well, that actually paves the way for a lot of global investors to get more comfortable with the market. It's a market that we've been involved with. I think there are many benefits to being in the India bond market. And this discussion that we're having this morning lifts the India bond market more in the minds of global investors. It takes its place as a major investment destination. And over time, as you pointed out, it actually opens the path for inclusion into other indices as well. So what happens today actually may have a longer road to run over the coming years.
Okay. What happens today? Let me ask that question to you very short term. I imagine that lots of investors that decided to invest in India on account of the index inclusion or are benchmarked to the index might have already positioned themselves. So is today, June 20th, the day we expect to see considerable flows?
I think there will be more to come today itself. But I would have thought, like you said, a fair number of index-aware investors would already have been positioned. If you have gone through the work to onboard, to open the market, to make it investable, you would already be positioned. And over time, more flows will come. I think there will also be what we call crossover investors, i.e. less index-aware investors will also realize the opportunity this market presents to them, and those flows will come. For today, I feel the impact may be a little bit more modest in terms of market price action, given that it's been well telegraphed and most investors will already be positioned in anticipation of this event happening.
Leonard, can we talk a few numbers? We've had $10 billion come in since the JPMorgan announcement. I'm not sure how much of that is strictly linked to that index inclusion development, but nonetheless, what do you think the ultimate flows will be, at least over the 10 months, as the India weightage rises to its ultimate 10% on that index? Some estimates put it at as high as 40 billion.
I think a run rate of about $2 billion a month over the next year feels reasonable. And I would arrive at those numbers just looking at the amount of funds that we estimate to be tracking the GBI-EM index. That's the index that's being included today. But beyond that, you will also, like I said, you will get some others below investors. So in the near term, that's more projectable. And I would say those numbers are also consistent with some of the other recent major market additions to the GBI index. So there is some consistency there. Beyond the next 12 months, I think the potential is there to continue at that run rate for a longer period of time. So in the near term, $20-30 billion feels unreasonable. Beyond that, $40 billion over a medium term also feels within reach.
Besides the index benchmark funds, which you said would be a run rate of about 2 billion, are there any numbers or estimates that you could share on, the active managed funds that actually might be drawn to India on account of this event?
So I think one of the other big indices that we could be considering thinking about would be the Global Ag Index. And I think if they begin to consider inclusion for India local bond market into the indices, that could also be a material game changer. If that happens, you could see maybe double the projections that we have right now. So the 20, 30, $40 billion could double over that period of time. But I think that's more of a medium-term horizon. And that will also, again, like I said, establish India as a material destination for global bond investors, as a real diversifier where you can add yield. That's an attractive proposition. So I would say 2030 near term, double that over a 3 to 5 year horizon, if not even more.
Great. T. Rowe Price has been invested in India for almost a decade, you told me. Is your position changing in India on account of this index inclusion? Are you adding to what you already have? What are the numbers there? Can you share that with me?
Yeah, so we've been, like we mentioned, we've been invested for more than 10 years in the local bond market. For a lot of our strategies, we felt like it was a good diversifier. It was a bit of a relatively underdiscovered gem. For some, it's a little bit more exotic. For others, we felt like it's one of the most liquid, high-yielding markets available. And that was a large part of the thesis around really being invested. Have we invested more funds recently? Where we have had index-aware strategies, we have topped up our holdings in anticipation of the rest of the universe following up behind. So I would say not materially more so for us, and maybe that reflects my earlier comments where investors that are aware of this market have already been set up and invested in this market, are already largely positioned, and it would be the others that would still have to arrive as they go through their market opening processes.
All right, let's talk impact on yield, on currency. What are you expecting will play out over the course of the next few months as the short-term reaction to this fund flow? And then longer term, what kind of pressure will this put on both yields and on upward pressure on yields and the rupee?
I think one thing to recognize is that the India government bond market is a large one. It's big. Yeah. And it's really going to be much more influenced by the domestic institutional investors, the banks, the insurance companies. The foreign positioning is going to be modest, I would say mid single digits, call it 4 to 5%, which is consistent with other big global markets. So the point I'd make is that the impact of the flow, I feel, would be modest in the very near term. And I think once we are over the initial stages of getting invested, most of this money will be largely passively managed. So they'll be relatively sticky. So in the near term, yes, I say over these the coming 3 months or so, we may see a bit of a rally as more investors get positioned. I would expect a modest rally in rates in response to that. On the currency front, I think it will be even more modest because the outlook right now is for the dollar to be a bit more in the ascendancy. And for the rupee, I would say it would do well to remain largely sideways. And in fact, it already has outperformed a lot of its EM and Asian currency peers. I'll put that down to the positive fundamental outlook for the Indian economy right now, the growth prospects. So The outperformance for the rupee is already there. And to keep it in context again, India is a very large economy. So these flows that we're seeing, the magnitudes, it may sound material, 20, $30 billion, but in the scope of the size of the economy, the scope of the reserves that are already being accumulated, and the natural flows that will occur in the day-to-day operations of the country, it's going to be a fairly modest impact. And yeah, I would expect the rupee to be largely stable, which has been the profile it has had, and I think that will be the result of these flows as well, which should be relatively modest.
Much of that has also been on account of RBI intervention, Leonard. So you expect that to continue with the intensity we've seen over the last several months?
Yes, I think that view remains intact, and that actually is a positive anchor again for the outlook for investment into the local bond market. We have seen a lot more pressures on EM currencies across the EM space, and that stability that the RBI has pursued for the rupee actually is a positive virtue for that currency. And again, what I said earlier, it actually it offers you a decorrelated, diversified opportunity here that we can rest a little bit easier, in terms of market profile relative to a lot of the EM. So I would say I expect that to continue, and I think that's a positive thing.
Okay, you said at least in your funds, you all are well positioned in India, and this event in itself will not, prompt you to add considerably more. But what will prompt you to add considerably more to your, position in India? What kind of events will investors like you be watching out to be able to top up your exposure?
There is a competition for capital, obviously, across the investment space. I think what could prompt us to add a little bit more into India would be less competition for capital from other global markets. I would say rate cuts across some of the other more developed markets, across some of the other lower yielder bond markets in the EM space, and also in the core market. So that would be one thing I'd be looking out for to catalyze even more flows into the typically higher yielding Indian bond market.
But we're expecting that, the RBI will follow suit as soon as we see the rate cut fever spread from what is currently the EU to the Fed. So will that, in that sense, that maintains India's investability. So besides that, is there anything else that you're watching for? Let me sort of, list a few events. We do have a budget coming up. I'm guessing you'll be watching the fiscal deficit number. Besides that, is there anything in the quality of spend you'll be watching? We have a US election coming up. What are you factoring in terms of your investment?
So a couple of things there. On the first part, when you talked about the global rate cut cycle, actually, if or when that begins to take place, perhaps led by the Fed, we actually expect the spread yield advantage for Indian bonds over core markets to increase, because classically, the RBI cuts at a lower amplitude than, say, a lot of the other markets that could cut. So that would actually widen the yield advantage for Indian government bonds. That's one. Two, I think on the fiscal outlook, we actually expect continuity in the fiscal profile, if not even maybe a modest positive surprise. Yes, we are paying attention to it, but I would say that the market is already very much focused on the fiscal outlook, and that's already very well covered. And that information goes through the market very, very quickly, with the local investors paying intense scrutiny. So I feel like that scrutiny already would ensure that the fiscal position would stay roughly intact and in a disciplined manner. And the third point you made was on the political outlook, perhaps. And in this regard, India has been a relative winner from the reordering of the geopolitical order. Everyone recognizes it's a rising economic and material power in this region. You could argue that the driver for growth within Asia has shifted from a north to a south axis. And I think the world does recognize the important role for India in that new geopolitical order.
Okay, great. One last question to you, Leonard, then. What could go wrong? I mean, I know you mentioned this is largely sticky money, but there is a deep concern, not just amongst policymakers in India, but the broader audience, that this is money that will move out very, very quickly. So what's on your list of negatives that could prompt, significant volatile outflows?
So we always look for predictability, governance, stability of institutions as a key guide rail for us when we are investing in global markets. In this regard, I think we are past one of the nearer term challenges. We've come through the election cycle, and that has actually been something that's reinforced the outlook for continuity in terms of the economic outlook and in terms of policy making. So I think that's a positive. We talked about it a little bit earlier. Classically, fiscal has been one of the vulnerabilities of the India story. So that would be one of the things that we continue to be watchful over. And if they can stay the path of the current run rate, then I think that would probably be a not negative surprise. But to your point, that would be where we could be a little bit more sensitive towards negative developments.
All right. Before I let you go, Leonard, two quick audience questions. I think both you've answered partially, but let me put them to you anyways. What do you think the impact will be on the rupee exchange rate? And the second one is, what will be the magnitude of repricing of existing assets post this index inclusion?
I touched on the rupee earlier. I felt that
I think the audience wants specific numbers, targets, outlooks. So.
Okay. Unfortunately, then the answer might not be terribly exciting.
Okay.
I don't expect a move I don't expect a move in any kind of magnitude for the rupee from here. Plus minus 0.5% would probably be my expectations. So fairly modest in that regard. As well, in terms of rates, the order over this period of time could be fairly modest again. I would say 5 to 10 basis points at the max in terms of a rally for rates. What could also be more interesting over a period of time is to eventually see some rotation of some of these inflows into other parts of the local bond market, perhaps the government-linked issuers and also some of the corporate bonds. And in these smaller asset classes, we could see a little bit more of an impact, but I expect that to be a secondary move after most investors have gotten invested in the Indian government bond market.
Leonard, Kwan, thank you so much for joining us this morning and sharing your insights with us on this.
Thank you for having me. Thank you.
I'd now like to turn to Chung, Managing Director of Principal Asset Management, where he's their Asia Head of Fixed Income. Howe, thank you very much. You've been listening into this conversation. And I do know that you have at least not the same position that Leonard has had, that you're invested in India very, very marginally. And so I'd like to start by asking you whether this index inclusion changes your view, stance, and positioning on India anytime in the near future.
Thanks very much, Menaka. First off, I think that the biggest part about today, if you take a step back, it's not so much about the inclusion of the bonds in the GBI-EM indices, but actually why we got here. I think if you recall yesterday, as we were talking about this, the fact that the Indian government did not accede to some of the requirements that the index provider needed them to get there, be it bond settlement or be it some of the tax issues, tells you that India is not looking for the flows in order to get to where they want to be. They want to be clear about what it means for foreign flows, to some of the concerns that you mentioned of. And it tells you that the global investors want exposure rather than India government being reliant on this flow. And this sets the backdrop on how I think we think about it. For ourselves, the exposure comes through very much the rates portfolio from a kind of lower correlated bond market, risk-adjusted carry from that perspective in the rates portfolio. And for the credit, it's really one of a way for us to get exposure in credit portfolios through the monetary policy that you can get through the onshore bond market.
Sorry, you're going to have to explain that to me in a little bit more simple English, Howe.
Sure.
So does that mean you will be investing more money towards Indian sovereign bonds or not?
So to your earlier question about our involvement, I wanted to point out that we are actually very much involved in the India credit space. But what it gives us being involved in the onshore bond markets is the ability to have the ability to be close to the monetary cycle, as our belief is that as we go closer into next year, inflation will be in a much better place for India. I think we're now around the 6 handle. It will move towards the high 4 handle. And this is going to set the backdrop of India being in a place of a strong growth, but somewhat inflation coming off, right? And this part of the cycle is very different from what we're seeing in the US, in the developed countries. And the difference in the cycle allows investors to have exposure to this. And that's what our intention is in the credit portfolios.
But you're not going to step it up because of this bond index inclusion.
No,
And
no.
is that on account of the, some of the factors you've already described? Or is
Yes.
it also because of procedural issues? I mean, are the tax issues the Indian government or policymakers did not concede on that? Some of the paperwork, is it all just too time consuming and bureaucratic for investors
No,
like?
I think for the investors who want to be in the market, they had already been in. The setup of some of these operational issues
Is
can
already
take
done?
time. It won't be in time for index inclusion day such as today, right? So the ones that want to be in are probably in. They are not going to depend on today. For investors that are off benchmark, I think the point is to give you a very differentiated kind of exposure that you would have gotten in other parts of the market.
Okay. What do you prefer more than India and why? Let me put it to you in that sense so that I get a better idea of what your investment outlook is.
Okay, in the India onshore space versus what we see in the credits, they give very different exposures, right? In the India dollar credit space, I think one of the most interesting part about India is what RBI is doing. We think that what RBI is doing, because of the high loan to deposit ratios, they have been actually subtly tightening in the financial markets, right? They do not want credit to be going to the places that they believe could be kind of that can have an overhang, and that is why many of the issuers that come in the dollar credit market offer a very different exposure, right? That there's a limit on the type of names that can go out, and that gives us names, be it in the leasing sector, consumer sector, even in the airport infrastructure, exposures that are different from onshore. Within the onshore space, it's really, from our point of view, initially about getting in touch with the monetary cycle where yields are still high compared to many other parts of the world. In the emerging market space, where emerging market investing has now become much more selective. You want to be in places not just about yield, right? Because if you think about it, IGB in the 7 handle or so, compared to many other markets, they are higher yielding markets. But it's really about the risk adjusted, lower correlated nature of this exposure that makes it attractive for investor globally.
Okay, I'll pull out a little bit more to get a sense of how you view what happens to this incoming fund flow over a period of time. And I want you to draw the contrast with China that went through a similar experience in 2019, 2020, and tell us a little bit about what that experience was like and how similar or different you think India will be.
So China had experience starting in around 2016, right? When they opened up the interbank bond market and then follow on with the bond connect. It's a bit more like feeling the pebbles as you kind of cross the river as well, because in China's case, they were quite keen to open up. Right. So when as they open up, they learn about the taxation issues. They learn about being important to be clear about what taxes was, how to make bond settlement easier for investor. So it was a gradual sort of opening. But what I would say they have kind of learned from it was that having a wider participation of investors was actually very helpful in times of stresses. Because when, for example, in 2020, when there were onshore selling, foreign investors took it as an opportunity to step into the China onshore bond market. This allowed the market to reduce in volatility as the onshore and the offshore investors balanced out their requirements for their demand for CGBs. And I think that's going to be the same case for India as we kind of increase in foreign participation. Because for China, I think they went from 2-3% to probably up to 10% in terms of holdings by foreign investors. In India now, we're quite low as well, 2-3%. And I think there will be expectations to go in the 10 or teens in terms of foreign participation, and that can help to balance out potential volatility within onshore. The last thing I would say is that another lesson learned was that in terms of the flow that came in, it was not immediate or a sudden kind of push, right? In fact, the flows that went to China was actually quite gradual. It kind of was staggered alongside the increase in weights in major indices. So it can potentially kind of take time as investors kind of go through the operational hurdles, understand the access to the market, and also vis-a-vis many other parts of the global markets that they can have exposures to, and continue to reassess whether this is the bond market and onshore bond market they want to be exposed to.
Okay, so a couple of quick follow-up questions
Yeah.
to that. That 10 to 12% foreign ownership of the Indian sovereign bond market, how long do you think that will take? What's the timeline that you expect?
I think it's gonna okay. So if you think about sizes, right? There are kind of two main constraints if you think about it. First, the foreign access bonds that offshore participants can get exposed to the India onshore market. The whole market's about trillion, right? But probably half of that is what you can get access to as a that qualifies, right? So that's naturally going to give you a cap. The other part of it is the percentage in weights in the indices, right? In GBIEM is going to go to a maximum cap of 10%. And down to EM investors, I actually don't believe many of them are fully index trackers. You can already see by the type of flows that came in, the 8, 9, 10 billion that you're seeing into India so far, actually less than half are into the benchmark kind of bonds, right? They're not really index tracking, right? They are buying the bonds off the runs. They are looking for opportunities. Offshore investors have a very different take than just buying the index tracking and being passive about it. So from my point of view, I think while you can have GBIM have it at 10%, the flow is going to be much more gradual, and it really depends on the type of cycle that we see India vis-a-vis the rest of the world that could result in potential larger or smaller inflows over time.
What securities do you think, since you sort of,
Yes.
distinguished how offshore investors would look at this,
Yes.
is it largely long-dated securities that they will be looking for? That's where we've seen some of the flows come in, because
Yeah.
that's the bonds that are included in the FAR category. But I just
Yes.
wanted to double check whether, the interest will eventually spread and then spill over, I imagine, over a few years into the corporate bond market as well. But on sovereign bonds, long-dated securities?
I don't think investors are averse to that. I think it's more about the benchmark being in the 5 or 10 year rather than want to be in the 7 or 14 year, for example, right? I don't think that there's going to be a major aversion to the long end, for example. But I would say eventually the long end base is likely going to still be onshore, be it insurance, pension players onshore. That will be a dominant factor. I think right now insurance players would own a quarter of that long end bond market. It should predominantly be the case, as onshore investors can come in and out of it. They wouldn't be averse, but neither would they be a major player in the long end.
Okay,
At this
How let's
stage.
talk a few numbers if possible.
Yeah.
Are you also estimating, let's say, a 30 to 40 billion dollar flow in the next 12 to 18 months? What impact do you think that will likely have on yields and also on the currency?
I would say, okay, so on first count, right? The numbers that are kind of driven by this is really about the 10% on the GBIEM base of 250, right? And that's how these numbers are coming around the 25 billion, right? The 40 billion is really about upon other indices, like what Lenny has talked about, be it in global ag. These are 2-3 trillions, kind of a base of money that follows it. And the expected kind of index weight could be anywhere between 0.5% to 1%. And that's why if you add up the total percentage, that's how people are coming up with the 40 billion. I would say there's a much bigger variation around these numbers because first off, as I said, I think many of these players are not index tracking. There is a very broad universe that they are investing in. So I actually think it depends really the point of monetary cycle where India is vis-a-vis the rest of the world that could could drive these numbers a lot more.
So what numbers are you working with?
I would say if you think about it, this year we're expecting an overall, when a year comes into place in March 25, when it gets to 10%, the total flow should be in the 25 billion or so. We have seen 10 billion so far. I think you can expect that gradual flow to continue because if you think about the backdrop globally, with global rate cuts kind of coming into place into this year as we start into next year, plus what's happening in the emerging market space, whereby India remains probably one of the most solid BBB names in terms of credit, in terms of the quality compared to many other parts of the world. That flow should be quite stable as we go into next year with the index inclusion.
We've already seen some softening of the 10-year yield. It's been very little, not very dramatic. But
Yeah.
you think that's the net impact that this event is going to have and no further, or do you expect further softening from here?
I think what we are seeing now is what the market is looking for with respect to, like you mentioned, right, with respect to the budget, with respect to monsoon, and we also had a MPC meeting that was quite divided, right, between the hawks and the doves, because the hawks believe the neutral rate should actually be higher, and then the doves are expecting growth to slow, right? But one thing that you could take away is that both sides believe that inflation will gradually come off, right? Be it you're seeing in some of these recent discussion on the minimum crop prices, right? The minimum support prices on crops, they have been fairly muted. And those are good signs for a Modi government that came in that believed that they could win a lot more seats, but it didn't turn that populist, right? There was a bit disappointment, but it wasn't. It was a disappointment around whether the party could win a lot more seats, but it was not a disappointment around policy continuity. It was not a disappointment around whether they would deviate from what that fiscal stance was, right? All these remain quite positive from our point of view, right? And that means that the conviction around inflation softening into next year, be it we have a decent kind of weather and monsoon season, that should set the path for rate cuts to come. And I think into next year, we'll be a lot more positive around rate cuts.
Any numbers you're working with on the rupee?
No, I think there's a function about what the dollar is doing that's going to be a critical factor. The other part of it is really about the Indian stock market. It has been basically the best performing stock market over the last 18 months or so. And as we kind of take this recent political events, we kind of get past this. The focus is going to move from one of driven by multiples into one of earnings, right? Into whether they can deliver the type of growth, deliver the type of earnings. So I think the flows that are going to come in are going to be a lot more muted from that sense. But the flip side of it is that oil price remains fairly stable. Current account remain quite favorable. And in the long run, if you think about the Modi government continuing on the path of increasing trend growth, increasing productivity, those set the pace for pretty healthy flows into the market, and that should be supportive for the INR in the long run.
Okay, I mean, I could add to that mix the fact that we've had FDI flows falling, but remittance flows, increasing. So you're looking at the INR at what, about 82 levels, or stronger than that?
I think we'll see it probably around here or weaker from here, given where the dollar is, as we kind of balance. Yes,
sorry.
I think our base.
That's
in the near term. I think
okay.
the medium term we are much more hopeful as we kind of get through this cycle.
So the near term outlook is slightly
a bit weaker. Correct.
At this point in time. Okay,
yes.
Great. So I just want to quickly get your view now on how India stands vis-a-vis other emerging markets, and there are events through the course of the year, that will influence your outlook. India versus, let's say, other EMs, and those events include the Indian budget. You've already sort of stressed on policy continuity. They will also include geopolitical events like elections, whether it's UK, Europe, or the US. And eventually, and I'm weaving in an audience question here, there is also hope of a potential rating upgrade, given that we saw an outlook change just a couple of weeks ago. So how does this position India versus other emerging markets feel?
I think you can break it down into two parts. The very first part is really about what's going on in India, regardless of what happens elsewhere, right? From that point of view, there's a kind of a medium-term structural story, which we know about the wealth, the rural urbanization push, and kind of the demographics, right? There's an angle, number two, about really the policy mix, right? In terms of the push and determination towards what we're doing in terms of reforms in the GST, in the bankruptcy sector. All these are sort of positive. And then the third being really about which part of the cycle we are in, right? These have to be set in place as we think about rating, potential rating upgrade, and how India kind of progresses on its own path, right? The one thing that we have been looking out for has been the greater integration of India into the manufacturing supply chains globally. This is really this China plus one that we're looking at. I mean, it's yet to be seen, but India has tried for many years in terms of moving from a very services-based sector to something that's more diversified and benefiting from the manufacturing global chains. So India, you can see from this perspective of geopolitics, while it can be volatile, it can actually, on the reverse, benefit as supply chains have to reconfigure in terms of where it benefits. And India, be it Vietnam, be it Malaysia, be it India, these are some of the places in Asia that we're actually quite bullish about such as these events happening. And of course, as we move into elections, there will be volatility. And what we'll be looking for is, as long as the domestic story stays sanguine and we keep up with the reforms that we need to do, those are actually opportunities for us to leg into a greater exposure from where we are.
Are there any external downsides that you have on your list, how that will change your outlook on India, not because of any internal policy changes, but just because the world has changed?
I think the loop between the global slowdown and financial conditions still remain a very big part of the risk for India, as much as it's very domestic based. This is because of the reliance on flows for India in the capital account, right? And therefore, this dynamic between whether it's not so much about the global slowdown affecting just the trade and what happens to India from export point of view, but rather the global slowdown causing dollar to move in a direction that's going to be negative for the INR, and it feeds into the current account, right? So this is something that we're more concerned with. If we go into a much deeper slowdown, the link between the global real economy slowdown and financial conditions. The other part of it, I would say, is through geopolitics, not so much as, like I said, they could be a beneficiary from China plus one, but geopolitics from a point of commodity prices, and India still remains a net importer of energy and commodities, and that still is an important part that we need to look out for in terms of the pace and the nature of the commodity mix that kind of evolves if geopolitics go in a different place from here.
How, if we see a faster China recovery than current indications, do you see any of the flows that you anticipated will come to India quickly shift destination?
I think there will be portfolio flows and FDI flows, right? But if you think about what the long-term and structural flows where we reconfigure supply chains globally, I think there is already a very clear direction whereby companies will need to hedge across globally, be it overly dependent on a single point in the supply chain to have all the supply chain in one country. This is where India is going to benefit as they want to kind of diversify their supply chain risk, right? I think this is something structural that will be positive for India. But in the near term, if China really kind of bounces back in a big way, you'll see some readjustment in terms of portfolio flows that might potentially move. But I think in the longer run, that thinking about needing to diversify supply chain, needing to find different sources of growth within the portfolios, that will certainly remain in the long run.
All right, Howe, thank you so much for joining us this morning and sharing your insights with me and our audience. Appreciate the time you spent with us.
Thank you very much for your time. Thank you.
And I'd like to thank our audience as well. Lots of questions which I have put to our guests, whether it was about what will happen to the rupee or yields in India, or the impact of, let's say, a change in the rating outlook and a rating upgrade. With that, thank you to all of you for joining us on this special Bloomberg India edition conversation. A quick reminder, if you haven't yet signed up, either for our newsletter, that's India edition, or for the Bloomberg India WhatsApp group, please do so. It's very easy to access, and you will get the best of Bloomberg on both of these platforms. Thanks very much for watching, and have a great weekend.